guys, this is Capitalism. I'm Danny, and today I want to talk to you about the coming outlook for 2023 and why I think that commodities and energy and precious metals and all that jazz is set to outperform pretty much everything else on the market. Before we get started though, I'm not a financial advisor. Nothing in this video is financial advice. Please do your own due diligence. It's your money, it's your responsibility. All right, so let's go ahead and dive into our first chart here. This is the Wall Street outlook for the S&P 500. Across all of these different investment banks, you've got everything from HSBC, Goldman Sachs, Bank of America, Citigroup, etc. And there really is no consensus here. They've got numbers all the way from 3,400, ranging all the way up to 5,000. So there really isn't a strong consensus across all of these banks in terms of what they forecast for the S&P for 2023. Now, does that mean that it could be a flat year? Yeah, it could be a flat year. We've looked at charts before that showed us that, you know, anytime we've seen years that have been down about 19%, which is what we saw in 2022, you typically have a flat year coming after that. Now, is that always the case? No, that's just the median. So what happens when everyone thinks that we have a recession? The banks seem to think that it's kind of, you know, it could be one way or the other, but there's a lot of sentiment floating around on Twitter and just anywhere in general. I'm sure pretty much, you know, anyone in your circle expects a recession. And what I want to show you next is, we talked about this before, but recession sentiment, recession expectations by way of the put to call ratio. So how many people are betting on a downside move versus an upside move? And we've recently seen a top in recession expectations using this put to call ratio. Now, what a lot of times I've indicated before in the past is that when recession expectations peak, you tend to see a rally in the market. Why is that? It's because when everyone's on one side of the boat, when everyone's fully bought into one thing, there really isn't any more money or any more capital to flow into that one area. Whether it be a short, whether it be a long, doesn't really matter. Just herd mentality. Now, this chart here shows us the contrary to that. And I'm going to walk you through it really quick. And basically, you've got 4 dates here that we're interested in. March 12th, 2020, February 28th, 2015, June 15th, 2011, March 17th, 2008. And what's so special about these dates is that these are all huge spikes in recession expectations. But look here. On this chart here, this chart here is looking at the S&P starting from March 17th, 2008, which is when we had this big spike all the way up here. Now, what happened? We had a 47% reduction over the next year, right? Not the big rally that you would think, looking at history. Now, let's look at June 15th, all the way over here. Second to the middle chart here. And you've basically got a 13% reduction after this big spike in recession expectations here on June 15th. Let's move down the list. You've got December 28th, 2015. And once you had this big spike in the put to call ratio and recession expectations, you also saw an 11% reduction in the S&P. And then finally here, March 12, 2020, this is when the world shut down. You basically saw almost a 10% drawdown from this recession expectation peak. So nothing is ever certain. There's always going to be contrary cases. There's always going to be counterexamples to things that happen in the market. It's because the market is very complex. It's too complex for one mind to fully comprehend it and fully make it predictable. You've essentially got billions of of nodes within a neural network, which is the people trading with one another for their own self interest, making decisions that that aren't able to be computed by any one program, any one person, any handful of people actually. The market is very complex and it's very dynamic. It's an important lesson to learn. And another to kind of dovetail of what off herd mentality. The herd seems to think that when the Fed pivots, the market's supposed to rally. And here's a counterexample to that. You've got this green line here, which is the S&P, and then you've got this brown line here, which is the Fed funds rate. Okay? So people are latching onto this idea that once the Fed pivots, we're going to see this big relief rally and we're going to go all the way back to the moon again. Okay? I'm here to tell you that's not always the case. Look here. 2001, we saw a big episode of when we cut rates all the way from about 7% down to about 2%. And in the market rally here in the S&P, no, it kept going down. In 2007, when we started cutting rates again, all the way up from about 6% down to close to zero, well, let's say it's 0%. Did the market rally? No, it crashed. Now, is the opposite true? When we raised rates here in 2004 all the way to 2007, the market actually kept climbing this wall of worry. When we raised rates here in the late 1990s, from 1995 all the way up to 1997, did the S&P crash? No, it kept going back up. Now, here's where we are now, okay? We've raised rates at a rate much faster than at any other point in history. Just look at how steep this line is. Okay? So maybe this time is different, I don't know. But if you look at this kind of stuff historically, a Fed pivot signals weakness in the market. And why is that? Is because if the Fed is willing to pivot, then what does that say about the underlying condition of the market? Think of it this way. If the Fed is a doctor and the economy is the patient, if you go to a doctor and you go for a checkup and all of a sudden your doctor's recommending you get on a bunch of drugs, a bunch of medications, get hooked up to an IV, are you going to feel bullish about your health? No, you're probably going to think, oh crap, what ailment has befallen me? What sort of godforsaken illness has have I been deemed worthy of in this world? So no, like the Fed pivot is not going to create some sort of rally in the stock market. At least that's what I think. I don't know. I could be wrong. Who am I? But historically speaking, a Fed pivot is a single weakness to the market. And why is the Fed raising rates? Well, let's look at this assortment of tweets from Wall Street Silver. And Wall Street Silver is quote tweeting a tweet from Michael Burry, and in which he basically says inflation has peaked, but it's not the last peak of the cycle. We are likely to see CPI lower, positively negative into second half of 2023, and the U.S. is in recession by any definition. The Fed will cut and government will stimulate, and we will have another inflation spike. It's not hard. So yeah, in the 1970s, we had more than one inflation peak. We had more than one cycle of inflation. And Wall Street Silver gets into that here. So he says that we're repeating the 1970s. In 1974, the recession reduced CPI from 11% down to 5% by 1976. The Fed then declared victory, went back to easy money. Inflation soared in the late 70s to over 13%. That's pretty much what everyone's hoping the Fed does. They're hoping that the Fed pivots and, we see this magical rally in stocks. But what'll it'll most likely cause is more demand and greater money velocity flow, which will spike more inflation. And to kind of wrap up what Wall Street Silver here says in the tweet, high inflation continued until energy policy was fixed. We have not fixed energy policy this cycle. And this is why I'm in to the commodity and energy space, as well as the precious metal space. Because I'm not dependent on what the Fed is doing. I'm not dependent on any of these idiots and what they decide to do for a given month. Whether they raise rates, keep rates what they are, I don't have to worry about that stuff. You can't change supply deficits. You can't bring back supply that's been destroyed through supply destruction. You can't fix shortages in the market through stimulating interest rates. No, you just can't do it. And that's the appeal to it for me. That's why I'm heavily weighted, let's say, in these energy and commodity stocks, because I'm not beholden. I'm not having to watch constantly to see what the Fed does. So how did they fix energy policy in the 1970s? 3 major inputs changed. 1, North Sea oil began flowing. 2, Alaskan pipeline began delivering. 3, Gulf of Mexico offshore oil scaled up. This is what brought inflation down to 3% by 1983. Exactly. So the Fed can't do anything about the supply side. You know, inflation can be caused one of 2 ways. It can be a demand side problem or a supply side problem. The Fed can only control the demand side. It has no bearing on the supply side. All the Fed can do is cause a recession or boom cycle by playing with interest rates and the Fed Reserve money printer and playing with their balance sheet assets. The Fed can't change raw commodities or energy policy or trade policy or any of these other critical variables. Exactly. So these things are finite and they're needed for the functioning society if we're going to continue living. If you believe in the ascent of man, that we're constantly going to require higher, denser sources of energy, this stuff has to come from somewhere. And if people want to, as Rick Roll says, flip the switch and see the lights come on, then the price of natural gas, the price of coal, uranium, all that stuff has to go up. Even oil. They used oil during this Arctic blast episode in the Northeast just a couple weeks ago. Not many people know that, but I think about something along the lines of 40% of the grid was run by oil. And speaking of oil, let's take a look at oil demand. There's a lot of chatter about oil demand and peak oil demand and all this stuff. Now, let's look at a chart of oil demand now. This goes all the way back to 1986, and you've got oil demand here in black. You know, it looks like a little saw here. It's about to saw open this graph and make its way up. But this drawdown here, this spike down that we saw in 2020, this was the COVID lockdowns that pretty much shut down the entire global economy. And you would think oil demand would drop like a bad habit, but it didn't. It only went down 15%. Let me say that again. We shut down the entire world economy, locked everyone down, and oil demand only went down 15%. And we've pretty much recovered from that. So what does that tell you? Yeah, sure, people weren't driving their cars around, but at the same time, oil is so much more than just transportation cost. You need oil for more than just gasoline or diesel. You need it to make the furniture in your house. You need it for the carpet in your bedroom. You need it for pharmaceuticals. You need it for everything, pretty much. In commodities in general, as we've talked about before, now these things are feeling a lot of constraint on the supply side. But we've seen a pretty big run up in commodities. So have we seen the end of this commodity bull run? Not really. Not if you look at this thing historically. This is the move that we've seen so far in commodities since the start of around 2020. This move from here to here. This is where we're at now. And this chart tracks the commodity index to the Dow Jones Industrial Average. Essentially, how many shares of the Dow Jones do you need to buy the commodity index? And we're at pretty much record lows. The huge run in commodities in the mid 2000s that we saw went from ratios of 0.2 all the way up to near 1.0. A 5x move in the commodity to Dow Jones ratio. Now we're still all the way down here. We're still in undervalued territory. We're at levels way below the early to mid 2000s. And that run was epic. I was too young to trade back then, but you know, we're still in very early innings, guys, with this commodity trade. And you know, we could go all the way out until the end of the decade. Because these supply deficits, just because you know, you give in to the fact, okay, well, we need to start drilling more for oil, we need to start extracting more coal. It's not a switch you can flip. You're gonna need to get drilling permits. You need to do your exploration. You need to develop the mines for all these materials. You need to produce the commodity. It's a long process. In some cases, it can take a decade just to fully operate a mine from the exploration phase all the way up to the developmental to production phase. And so, as we continue down the 2020s and into 2023, it's looking more and more like the decade of commodities. And this chart tracks prior decades and what their major theme was. In the 1950s, it was European stocks. In the 1960s, it was Nifty 50. In the 1970s, it was energy. It was energy, commodities, emerging markets. In the 80s, it was Japanese stocks. In the 90s, it was American tech. In the 2000s, it was emerging markets like China and commodities. In the 2010s, it was the American mega caps. And now in the 2020s, you know where I stand. All right, guys, if you like this content, that's what I got for you today. Go ahead and subscribe to the channel, like the video, share, comment, do all the YouTube stuff that I'm supposed to tell you to do. Let me know what you think. Which one of these commodity sectors do you think is poised for the biggest breakout? Is it, you know, something along the lines of oil, or is it uranium, or is it natural gas, or is it battery metals? We're gonna have to drill a lot of battery metals to meet these 2030 goals for electric vehicles. We're gonna need a lot of nickel, cobalt, copper, lithium, even silver to create all these batteries. So let me know what you think, and until next time, guys, bye.